welcome to this Diwali special. Samvat 2080 has been absolutely fantastic. A near 30% rise in the Nifty since last Diwali. The freight train of local retail money into the markets looks unstoppable. We are tracking now $4 billion a month into equity mutual fund schemes every month. On the fundamental side, India remains the fastest growing economy globally and is riding on multiple levers of demographic dividend, huge domestic market, make in India, unicorns, infrastructure development, and so on. The question, though, is what will Samvat 2081 hold for stock markets? I have with me someone who has all the answers. Manish Chokhani of Enam Holdings is with me.
I have all the answers.
Manish, great to have you with us here. Season's greetings and wish you a very happy Diwali.
Thanks for having me.
I want to start by, and we'll get to the answers later,
Sure.
but just, something which is going on, which is this FII selling, what we've seen. I just want to start with that. What's going on? It's been almost $8 billion a month to date. It's the fourth largest episode of outflow from foreigners ever.
A bit like 2008, except the base is very different.
Much larger.
We're 3.5 times of
Absolutely.
that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction.
Yeah.
But having said that, foreigners own 15-16% of India. So it's about $800 billion at least of stock which they have.
Yeah.
So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets, of which 15 has come from companies raising it for building new capacities or whatever.
Right.
But 15 has actually been promoter and private equity selling.
Right. Encashing stock.
Encashing stock. And these promoters include the foreigners from all over the world, like the strategics like GE and Whirlpool have sold from US, BAT and Vodafone have sold from UK, Sumitomo has sold from Japan, Hyundai and soon Samsung will sell from Korea, Singtel has sold from Singapore, and indeed even our own Tata Sons has sold down some TCS, Anil Agarwal has sold down Vedanta. So people realize there's a good value being provided by the market, why not take it? When people sell and take money home, like it happened in the early 2000s when Warburg Pincus encashed Bharti, it opened the floodgates to private equity in India. So if this sort of selling can get absorbed, it creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa, where I can come in but I can never leave. So it may not be a bad thing. And we did need the market to cool off.
When will they stop leaving is the question, though. And why are they leaving? Foreigners especially. What's your sense?
That's why I gave you. The context is if you have 800 billion and you take 10 billion home, they're not leaving.
But it's just that it's very concentrated.
Tactically readjusting.
Right.
And the fact of the matter is...
But tactically readjusting because of what? Because India is expensive?
It is super expensive. No one's denied that. I think if we did not have this 50 billion of inflows from domestics, I don't think anybody was arguing this is a cheap value market where you should go in and take fresh positions.
Right.
Everyone's happily riding the lifting tide, but earnings are slowing down. You've got the stimulus happening in China. You've got, hopefully now, the US having a second leg of growth. Indeed, if the markets believe that Trump comes back and you get tax cuts and you get tariffs and US prosperity will come back, you have a $62 trillion market cap sitting there, on which if you make 10%, you still make $6 trillion. As opposed to even if you make 25% on the Indian 5 trillion, it gives you an extra trillion. So percentage gains and absolute gains play in people's minds.
I'm going to come to the US presidential elections in just a bit, but this consumer slowdown bit, right? So one is valuations. That is the only bit, right? There's no other, there's nothing else.
Look, India, let's think about it, that we came post-COVID from a rebound perspective, that the big themes we talked about, consumer discretionary has played out. We talked of the platform plays with the Zomatos and the others have all played out. We talked of privatization plays, which is the Adanis and the Bhartis and all have all played out. You wanted the financialization play to happen, which everyone assumed is only banks. It played out in PSU banks and the ICICI banks and all the others. And the capital market plays have fantastically performed and great wealth creation for everybody around. And then government came and stepped on the gas with PLI. And the infrastructure spend. So it gave you the whole new fillip on PSUs, defense, road, rail. And they've come like a springboard from a low which was held back. But if you take a compounding from 2018-19 to now, the earning compounding is pretty much what it should have been in the mid-teens.
But the price growth has
And
been...
the cyclicals are the one which have come back, which also remember the last time they had their day in the sun was 2008 bull market. So all the capital goods, defense, industrials, real estate, they went nowhere from 2008 to 2021. So don't deny them their place in the sun, let them enjoy a few years. Our problem as investors is we may be overpaying for it upfront, which also we've spoken so many times in the past that we should be the center of a melt-up in this decade. It's happened with the domestic flows. I'm underwhelmed with what's happened with the global flows.
Global flows have underwhelmed. It's not happened.
Absolutely. And even FDI, because other than the Magnificent Seven, which are generating money hand over fist, it's not like the old industrials or the old consumer stocks in the world are doing well. And they all got levered up to the hilt to do buybacks and reward their executives. So it's not like they're looking to expand. And then the half of manufacturing GDP of the world is around the auto industry. And they're just shell-shocked with what the Chinese have done with EVs. So and you see the way the European chemical industry is kind of getting hollowed out and selling left, right, and center. So in that mood, you're not likely to say, let me go out and expand. The expansionist tendencies and businesses are going to come out of Asia now, largely, or maybe the Middle East. So the Middle East money, I think, is still coming with the sovereign funds and so on. But unfortunately, the Asians, and especially the Japanese, have still not come in big force.
Both FDI and portfolio flows?
Both ways.
So that is still pending, you would say?
I think it's still pending.
It's still pending.
Yeah.
Not just from Asia, but from the West as well, at least portfolio
from the
flows.
West. Portfolio flows from the West, FDI from Asia and Middle East. I think there will be significant money coming from there.
But do you think we go in for a period of, at least from a market perspective,
I pray and hope. I've been saying it in everything. I think we will get to a melt-up at some point in this decade. I'll hate it to happen because then 20 years are forgotten decades, like it happened to Japan, like it's happened to China.
But right now, are we at a bit of an inflection kind of point?
Right now,
or no?
supply is meeting demand, right? When you're seeing this kind of selling and $3 billion can be paid back to Hyundai to take home, it's telling you supply is clearly rising to meet demand. I just hope even government encashes and privatizes, because if they can take money from the markets at 3-4 times of what they invested and re-put it back to creating more infrastructure and other assets, it's only going to accelerate growth. Because remember, the free pass we got after COVID of inflating the fiscal deficit is now gone. And that gave us the rise of infrastructure, defense, rail spend, which as you have to dial it back now for welfareism, which is the need of the electoral hour now, you're going to get a shock on that side, that the capex suddenly levers are pulled back. And now the worry is that with the K-shaped recovery, the top end has gone and bought their bigger homes and their bigger cars and their holidays. What happens to the bottom of the
Do you think that is the problem?
It is a problem.
Which
and,
is,
I mean,
no,
clearly,
it's coming into stark view. The top end is maxed out in that sense.
It is in stark view. I don't think you're going to, once you bought a Mercedes, you're going to come back to the market 5 years later. Right? Once you bought a larger home, you're coming back to the market 20 years later. And the pool of those top-end homes in India is still very tiny. Like I call it Australia, Philippines, and Africa. The Australians are kind of happy and done. The Filipinos in the middle 100 million of India are, I guess, too busy making money in the market right now, whether through FNO or SME and so on. But that delayed gratification, but see, the wealth creation has been so large that 85% of this $5.5 trillion is Indian wealth. And not only on that front, on real estate, values are up. Real estate value easily would be 6-7 trillion in India. Gold value is easily $2 trillion in India. So you add all this together, bank deposits are probably a couple of trillion, if not more. So the domestic wealth creation has been large. So it's not like consumption will fall off a cliff. But the rate of change which one saw, that spring which came after COVID, I think...
And which lasted, all till now. I mean,
it's lasted. And I mean, when you see like someone creating like Trend did the value retail segment and they opened up with Zudio and others have followed. That space, which is the Filipino space, I call, has just expanded dramatically. Or when Zomato tells you I can deliver you something at home for a couple of $100, it just expands the whole market. But it's not indefinite. And that's what I find in India, that we get excited when you get these inflows and the mutual fund portfolios go up. But at certain point you hit a stall speed because you've gone through the Australians and you've gone to the topper end of the Filipinos, and you can't keep drawing a straight line on an Excel sheet and say this will continue forever. So the asset allocation mix in favor of financials is for sure, But this rate of consumption growth is not, I think, so easy.
So then maybe we are in for a bit of a earnings slowdown, right?
We are, clearly. No one's been denying that. I don't think anyone in the market.
But a cyclical kind of slowdown which lasts how long? A year?
So you need a second wave of impulses to come out. And like I said, the first impulse wave has come. The second impulse wave, normally you get either a catalyst by way of an important industry or an important commodity going up, which probably will happen with precious metals, gold, silver and all, and there's a lot of it in India. That gives you another wealth effect and maybe another booster over there. But the government part which is lacking is on jobs, regulatory reform, skilling, which they're trying to do with the apprenticeship thing.
Which is the detail-oriented hard work.
But it's the harder stuff. And look, the two, three big misses of India, which we've done really well for the last 10 years. But the 2, 3 big misses, number one on energy, we've still not either drilled, we've not used the nuclear treaty to build as many nuclear plants as China is doing. We've not done enough on solar. We're doing a lot, but it needs to be 5x more. Like our port capacity is still, I think, 1/5 of what China has reached. So long way to catch up there. So we've caught up on roads and telecom. We're halfway there on airlines. But ports, power is still huge surplus, and that's why it's a bull market in a lot of these power and transmission stocks. So a lot of work still to be done there, number one. Number two, like I said, this whole privatization to create the animal spirits again and maybe attract foreigners as well is item 2. Item 3 is my perpetual bugbear. We can keep dropping the value of the rupee, but until you have FTAs in place with the major trading centers of the world, you will not be part of global supply chains. You can take the rupee to 120 and your exports are not going to lift off. And unless you give the price signal that rupee can even appreciate, not only depreciate, what's my incentive in India to then compete on quality and product with the world? So these 3 things are the catalysts which I look for. I think privatization and Indian rupee appreciation I may carry to my grave. We've been hoping for 20 years, but it will happen. I think it's coming.
So we're waiting for wave 2.
Wave 2, you need
fresh set of
labor
impulses.
reform. Like which factory?
Out of everything that you mentioned, the easiest is another asset price sort of lift coming in from gold, silver, precious metals.
You need that. And the privatization.
But don't you think that's already happened with gold and silver?
I think it's a breakup because this debt debasement of the world currencies is extraordinary. No one's paying attention to it. We are so focused on our equity markets. The amount of debt in the world is staggering. When US writes a $500 billion check to fund the Ukrainian war, whose money is it? Our entire reserves are created at the stroke of a pen by America in a few months.
Or a keyboard.
What are we doing?
Why
are we holding this?
Let's talk about the US, right? So, by the way, on debt and deficits, there was a report recently which said that Trump, if he is elected, over the next decade will add $7.5 trillion
any
debt.
Politician anywhere in the world is
But
going to add
on the other side, Kamala Harris will add $3.5 trillion. So Trump is great for equity markets, expansionary, but bad for bond markets. But that's the general kind of broad thinking. Who's better for emerging markets in India, in your opinion?
See, again, I'm not an expert, so since it's Diwali, we can shoot the
here,
breeze a
so
bit.
it's like,
True. But so typically the Democrats have been warmongers. It's very, very sad to say, but because they tend to be kind of moralistic that we will go and support this. And the Republicans, which are more conservative and fiscally oriented, like this is why we're spending this money. And Trump just says it in a more blunt manner, that why should I be paying for Europe's war or for Taiwan's war? Let them pay their own bills. So I think if Trump comes, the way the betting markets now seem to be suggesting, you get a lot of these wars wrapping up quickly. There will be some negotiation and settled. But he's also a tariff guy, and he wants Make America Great Again. You put tariffs up, it's inflationary. You cut taxes, it's inflationary. It's bad news for bond markets, as you said. It may be great for equities in the short run, but when you get inflation, you get rising rates. And you get currencies weakening, which is why the trade this decade I still feel is hard assets and precious metals, gold, silver, uranium and stuff like that. And uranium, silver are playing into this energy, data center, AI theme because you need all this for the amount of energy these guys are going to consume. So whether it's Trump or it's Kamala Harris, dollar has to weaken, inflation has to come back, and it's just that the Democrats will probably let these wars linger on for longer.
But Trump is, so he's make American stocks great again, or Indian stocks also fine?
Oh, look, when typically look, US is anyway 62% of world market cap.
Correct.
It's unsustainable.
Correct.
A lot of these stocks, the way they are running, they are now running into regulatory crosshairs as well, right? The breakup of Google and so on. Also, the Europeans have woken up, Indians have woken up that what about data localization and so on and so forth. The fillip which is happening with NVIDIA right now, with this AI capex boom, people are forgetting it's probably a cyclical capex item. And the productivity gains of AI still lie ahead. And I don't think it's been priced as a cyclical stock because earning momentum is still so strong.
Right.
But if and when this plays out, and you have dollar weakness, tariffs and so on, normally this results in a boom in emerging markets.
Okay.
Because then the Indonesians and all also get into the act and they can start cutting their rates and their commodity prices lift off. And we are beneficiaries. Actually, a lot of Indian earning growth looks low because oil and gas, metals, cement all have slowed down dramatically.
Correct.
So we want inflation in that sense to see profit growth. No one in the equity market looks at 7% real growth, and if there was 7 real plus 7 inflation, you'd get 15% plus plus plus. So it would be 16-20% nominal profit growth, and we'd be celebrating. It's bad news for obviously the consumers, which is what RBI does. But the way to tackle it may not be through harder rates, but through stronger currency.
We'll take a quick commercial break here, but don't go anywhere because Manish is right here. I'm going to come back and continue this special conversation, Samvat 2081. Stay with us. Welcome back. You're with us on this special edition of Market Master, Samvat 2081. We're in conversation with Manish Chokhani of Enam Holdings. Manish, let's talk about the one area where you have comfort, which is financials and private banks, which is where it's not really played out, right? HDFC Bank numbers came out and they're very healthy. I mean, almost opposite of what many others have done. And it kind of, their underwriting, etc., shown through. The slowdown on sort of unsecured credit, etc., at a time when others were sort of, what's the sense?
I love this because somehow everyone now thinks I'm the HDFC bull. It's one of the stocks in my portfolio. But to give context, like we said, in cyclical terms, when a market peaks, if you made a top in 2008 with all these industrials, it took them a period of time to come back, including the Reliances and all of the world also didn't come back till 2020. In the last decade, what were the stocks which performed? Quality, right? It was Nestle and Page Industries and Kotak and HDFC and the others. And it was understood this bull markets, they're not going to be the leaders. And while people think financials haven't performed, look at what happened to PSU banks.
Correct.
Look at what happened to small banks. I own, for example, IDFC and others. They've come roaring back. And it was expected that you'll go through consolidation in the sort of quality banks. And now others have also caught up to that quality. And you've got to a stage where the expectations are now so low from the HDFCs and the Kotaks and the Bajajes of the world that when you get this kind of result, we are celebrating because like it happened with PSU banks, I remember I used to say when you go from terrible to bad, it's a rate of change and that gives you a big jump in multiples, if not stock prices.
Correct.
The same thing here, that the expectation set is now so low in banks that the trend for price appreciation has become better. Having said all of above, banks are $1 trillion worth of market cap in aggregate. So we can keep finding reasons why they're not performing. The reality is $1 trillion and largely free float.
It's a lot of money to move it.
And it's free float.
Yeah.
So if 100% of HDFC Bank has to be bought by someone or 100% of ICICI has to be bought by someone, it's not like a small cap where you can put few hundred crores and boom, the stock is up 50%. Here you need a couple of $1 billion. And that $1 billion, unless the foreigners come back, is not going to happen in a rush. So I think while we'll get this bump up currently in HDFC, I don't think the wall of domestic money is enough to push it up. Plus, they're capped at 10% holding in portfolios in the mutual funds.
Last time we spoke, you were cautious on mid caps, small caps.
Still am.
So they say fish where the fish are. Where are the fish?
No.
What areas?
Look, there's enough things to do in India. I think the point I was making is that people have been buying momentum. That if earning growth is 200%, I can pay 150 PE multiple. That is irrational, what is going on.
Sure.
And I was pointing out your return expectations have to now get muted because you compounded earnings at 24% in mid and small. that 24% ain't happening going ahead. Because if the whole economy is generally on a slower path and slower inflationary path, this is not happening. Even the sectors which are doing well, like say power we like a lot, but if ABB, Siemens are valued here, and it's a cyclical stock, it takes a number of years of earnings to catch up. But your returns from a 50, 60 rupee price is very different. At that time, it was a 5 billion market cap. I could say in 10 years, it can get to 50, and I can make 24% compounding. At a 275 rupee price, to even make a 15% compounding, to go to 120 billion is not going to happen. So it's just a price-based thing. In the market, there are enough things to do.
Like what?
So, again, if I go back to financials is number one.
Okay.
This whole energy, renewable energy kind of is area number two. The whole hard assets is area number three. And in that, what else have I done recently? Let me think. So I have renewables. I have an airline stock, for example, believe it or not, that there is a, hopefully a revival in that as well. And number of these things, we have still years to catch up with China, and there's fear about execution and so on over here. So there's enough to do. I mean, from an individual investor perspective, there's enough to do. And it's not a market which is going to crash, and therefore you say, I want to sit on cash.
It's a hold market, basically.
It's a hold. I'd be very happy if we go sideways. Because remember, my underlying theory still is, at some point we have a melt up in India. So I just reiterate, the horses that you know best. And again, the names I just mentioned in passing, I'm not meaning to recommend, and they are tiny parts. But I just say it's enough to do in the market rather than say, let me go and build 25% cash.
Absolutely. And in renewables, it's through financiers or?
No, not through financiers. You'll get enough over there. I mean, just look, there's enough. The whole power energy transition is still a big thing.
Okay. Anything else at all? I mean, any other any new sector?
It doesn't, listen, I don't have to go shopping every day. I'm a farmer. I plant the seeds and I wait for the crop to grow. It may take 3 years. The longer it takes, the better, because you get the underlying compounding. And I'm in no eagerness to harvest the crop. Because I have no need to harvest the money and take it elsewhere. I'm going to be here invested in India.
Next Diwali will be higher or lower?
Next Diwali, if we get double digits from the index, I would be surprised. I think at some point, and there are a lot of stocks. Even remember, we've spoken in the past about EMS. Some EMS stocks are down 40%. And it's not like the story is over there. Some of them are over 100 multiple. Some of them are not. So you get things over here.
But you're saying you'd be surprised if you get double digits.
If you get double digits from an index perspective, despite the large caps being the store of value today, is difficult. And that tells you what likely to happen in the small and mid as an index.
It'll be a time for reflection and holding on to the horses that you know best, as you said.
So again, I just repeat what we said last time. Asset allocation, please think carefully. Within that, your basket of large, mid, small, please think carefully. Position sizing, please think carefully, because some of these, even in our portfolio, become disproportionate by performance. So it may be time to prune some of them just from a sanity perspective. And fourth is just count your blessings and go and enjoy with your family's Diwali. Stop thinking about making money off it.
Use it, right? Thank you so much, Manish.
Thanks for having
great
me.
conversation, and wishing you all the best.
Thank you. Wish everyone a very happy Diwali.
Thank you.